Part 2, now we're going to cover notes receivable. Notes receivable. Interest accrues over time. Discounted note, interest deducted at the beginning. Zero interest notes, interest is implied. So now we're going to go through examples of all three of these. Now we sold $100,000 worth of goods in exchange for a 6-month 12% notes receivable for $100,000 on July 31st. Journal at the point of sale. At year end, assuming we're not accruing each month, we would accrue 5 months worth of interest revenue. When we're paid in January, we would record our notes, take the notes receivable off the books, take the interest receivable off the books, book the 1 month of interest that's left, and record the cash of $106,000. Now, what if it's a discounted note? We sold $100,000 worth of goods in exchange for a 6-month 12% discounted note. Notes receivable is $100,000. Discounted notes is $6,000. Sales revenue is $94,000 because we have to account for the interest. Accrual at year end, we would go discount on notes, interest revenue, journal entry, is we would now show our last month's interest and take our notes receivable off the books and book the cash. Now what if we have a non-interest bearing notes receivable? So on December 31st, Mike renders services to Danny, accepting $50,000 down and agreeing to accept the balance of $90,000 at the end of 2021. Which means we're going to have $19,20 in 3 years, an assumed imputed rate of 12%. So we're going to prepare the journal entries. And we're going to use the effective rate. So, since you're getting $90,000 at the end of 3 years, you have an effective rate of 12%. You go to the present value table and look up the factor for 3 years at 12% to determine the present value for the services, which would be $64,060. The down payment of $50,000, the capitalized value of the services is $114,60. So, cash would be $50,000, notes receivable would be $90,000. Service revenue is $114,060. Discounted notes is $25,940. Which is the difference? Now we'll look at this schedule to see what this means each month. So, on 12/18, the carrying amount of the note is the $90,000 minus the discount, gives you $64,060. We're going to take that times the 12%, that gives us our interest revenue, plus the previous balance. We now have a carrying amount of $71,747. We're going to take that times 12% the next year. We get interest of $86,009, plus $71,747 gives us a balance of $80,356. And then our last year, we would just do a plug, and in this case it comes out. It would be $9,643. That would be 14 cents, the amount of interest we would book. Now, what would that look like on our T accounts? As you can see, it zeroes them out in the end, which is exactly what we want to do. And remember, with the effective rate, the interest revenue is going to be different on each payment because we're always going to take it times the net book value at the time we do the calculation. So, what do our journal entries look like? Here's what it looks like when we actually book it. Again, this would be our entry at the end of 2019. We'd book our interest revenue. This would be our entry at the end of 2020. And then we would receive our cash, our notes receivable, and book our last interest revenue. Now let's take a look at another example. We're going to now look at a non-interest-bearing notes receivable when we have payments over time of equal amounts. So in this case, provided services for $50,000, and then we're going to get $30,000 at the end of each year. Since you're getting equal payments, we would end up with an amount of $122,055 for the services, and the difference would be discount on notes receivable. Now what we're going to do is we're going to figure out how to figure out our interest. And remember that interest is always going to be the balance times the effective rate, and it's going to change every year. And in the end, you should zero out the discount notes receivable and the notes receivable, which is what we're doing here. No, that's not right. Part 2, notes receivable. Notes receivable. We can have a notes receivable where interest accrues over time. We can have a discounted note where the interest is taken out front, and we can have a zero interest note where the interest is implied. And we're going to go over examples of all three of these. Now, when we just have a notes receivable, what we're going to do is we're going to book the face of the note and book the whole sales revenue at the point of sale, and then the interest is going to accrue over time. So at the end of the year, we would include 5 of the 6 months' interest we would accrue, assuming we have not accrued it each day. Then when we make our final payment, we would book the last month's interest revenue, take the receivable and the note off the books, and book the cash. That one's relatively easy. Now, what if we have a discounted note? In this case, the interest is paid up front. So, the notes receivable, we would take out the interest, and they would only get part of the money. You always pay a higher interest rate when you pay interest up front because you receive less cash. All right, accrual at year end, you'd have discounted note, interest revenue, and when it's paid, this is what it would look like. Now, what happens if we have a non-interest bearing? Well, non-interest bearing note. On December 31st of 2018, Mike rented services, received $50,000, and agreed to accept $90,000 3 years later, and there is implied interest of 12% for these services. So, if you're getting $90,000 in 3 years, it's not worth $90,000 today. And remember, the higher the interest rate, the lower the current value. So in this case, $90,000 at 12% is only worth $64,060 in today's dollars. And I would go on to the present value table. I would gone down 3 periods, and I'd gone across to 12% for my factor. Plus the down payment tells us the total value of the services. So I would book cash, notes receivable, service revenue, and the difference would be discount on notes receivable, which is actually interest revenue, which you're going to write off over 3 years. So we would take our beginning, which is our net book value, which is the $90,000 minus the discount of $25,940, and we're going to take that times 12% to get our first interest revenue that we're going to record. We now have a new carrying amount, and we're going to take that times 12%, and we get $8,609.66 for our interest revenue. And then we get our last year, we take $80,356.86 times 12%, and we get our last interest revenue that we earned. And now our carrying amount is $90,000, which is the amount we're going to receive. So what does it look like in our T accounts? Remember, at the end of 3 years, both these accounts have to zero out. And remember, whenever you use the effective rate, your interest, revenue, or expense is going to be different every year. So, There's our first journal, our second journal, and our final journal. Now let's look at this. What if we have a non-interest bearing note, but we have payments over 3 years of the same dollar amount? Remember, in order to use the present value of an annuity table, they must be the same dollar amount. If they're not, can't use the present value of an annuity table. So we go to the present value of an ordinary annuity table because the first payment is at the end of the period. We go down 3 years, we go across 12%, and we get our factor. And 30,000 times the factor gives us 72,033. Plus the cash, we now are going to book services of 122,055. And our discount on note, the receivable is going to be 17,945. We're going to go through the same thing. We're going to amortize it each year using the effective rate, which is going to mean that you're going to change it every year, the amount of the interest revenue. And we always use the net book value to determine interest revenue. So, for the first year, at the end of 2019, we're going to take, of the 30,000 we received, we're going to take our 72,055 times 12%. That tells us of that 30,000 we received, how much of that is interest revenue and how much goes against the principal. The next year, we're going to take our principal of 60,000 minus 92, and that's going to give us 50,701.60 times 12%, and that gives us our next payment of 6,084.19. And now we're going to do our last one, which would zero out. That would be our last recording of our interest revenue, which is going to zero out our account for discount on notes receivable. And when we get our last payment, we're going to it will zero out our notes receivable. So here's our journal entries. And here's our final one. And that ends this presentation, part 2 of a 3-part presentation.